Good morning. Today is Tuesday, September 15th, 2020. This is the Arlington County, Virginia Board of Equalization hearing. The first case on the agenda is an economic unit. The RPC number is EU 150-1212A is an apple, 3150 12th Street North. Mr. Jeremy Chitlick is here to present for the appellant. Mr. Chitlick, you can start with your 8 minutes and tell us about the property.
All right, thank you. In front of you is a 272-page packet that I'm sure we've all read front to back. A lot of this is forms and decisions because of the type of property that it is. It has a lot of lots. The property split where it has a 5-level portion and a high-rise portion, so it's a mid-rise, high-rise split. Our understanding from the county in the past is that those properties, you call the property what the tallest floor is. So if you had because half of it's mid-rise, half of it's high-rise, the county's position is it's all high-rise, which we dispute a bit. But the main issue here that we have with the property is well, you know what? Let me just go to page 3 because that's kind of sums everything, and I'll show you what happened here. There is and I say page 3, it's actually page 6 in this packet. It's a side-by-side. You have a 4-year history of income here. But what the assessor's done is he's pulled out what he thinks it should not have been included. So these are equity residential properties where you'll see that 4 years back the expenses were 17% and then 19%. And in both those years they didn't actually report RUBS. In 2017 the RUBS were added by the jurisdiction. And then in 18 and 19 the RUBS were added back in, but then the expenses were actually stabilized. So the current expense rate is 25.71% in the most recent year. The county's original assessment used 20.75%. They've now looked at the information and said, you know, we see what you did, but we don't think that all of the maintenance and repairs should be included. So we're going to pull that out and report it to you as operating expense without CapEx. So I'd like you to look at column D and column G and note that those are not what was submitted on the income and expense forms. That is instead what was submitted in the income and expense form, and the assessor pulled out some of the things that he did not feel that were appropriate. Specifically, in 2018, he pulled out $13,000 of information of expenses there to say it shouldn't be $2,098,000. It actually should have been $2,085,000. So when we're talking about over $2 million, he pulled out $13,000 and said this shouldn't have been included. And down below, you'll notice that they're talked about what's turnover expense, what's painting, carpet, etc. You have to realize that although we are used to looking at this on a daily basis, and the county's used to looking at this on a daily basis, owners get these income statements that are 3 or 4 pages with 3 pages of instructions, and it's a little difficult to tell what should go in what box. And when somebody owns 500 properties across the country and they're filling out 500 of these in 300 different jurisdictions, again, it's pretty difficult to say, is this decorating expense? Is this turnover costs? Or is this painting, carpet, etc.? And because the county has determined that to them they put it in the wrong box and didn't follow the directions like they wanted it, it should not have been included. So yes, things shift from one box to another, and that's what happened here with, is it turnover cost? Is it painting, carpet? Or is it decorating expense? You paint a unit. Are you decorating the unit, or are you painting it because the last tenant, because the new tenant's coming in? Well, it's kind of both, right? So which box goes under doesn't make the expense any less legitimate. So in column F is the actual operating. That's reported on the INE. And you'll notice the NOI was $7.16 million. The county has determined that some of those expenses shouldn't have been included, and the actual is $7.3 million. So they were originally using expenses of 20%, saw that the new expenses are 25%. They made some adjustments here. The test here, they used a 4% on the test when the original 6. I don't know why that's the case, but the end result here is a value decrease by the assessor, but an NOI being used that's $150,000 higher than actually be achieved. I can go over the details of the property, but I know you've had our packet for some time, and we do a pretty good job of laying it out. So I apologize if you'd prefer me to do that, and if so, please let me know. But the details of the property, what it looks like, what's there, pictures, all of our issues are highlighted in our narrative, which we've included which is pretty detailed. So I didn't want to use my 8 minutes to go over that. I really wanted to focus on the merits of the case and the issues that we still disagree with. So for once, I think I'm not going to use all 8 minutes.
Okay, thank you, sir. Mr. Chikas.
Good morning, board members. Good morning, Mr. Chitlick. Good morning, Mr. Warren. What we're talking about, of course, is the Clarendon Apartments. Again, the board is fairly familiar with how the county does their work. We'll focus primarily on the 3-year summary sheet, mixed use income and expense summary sheet. As you can see, in years 16, 17, 18, and 19, per Mr. Chitlick, we did include extra columns, column B and column G, which are reconstructed from the owner submitted INEs minus the capital improvements that we've talked ad nauseum this year and years previous. They're inappropriate expenses. That's why they're listed below the line. No of the owners that we know of attempt to use them above the line as annual expenses. So we expressed that to Ms. Ross and Mr. Chitlick, and expressly asking what explicitly was spent on capital improvements and what was spent on other items. We've listed that in the packet. You can see that on beginning, I believe it's on page 144, 272 emails that Mr. Chitlick was included on as well. So in regards to the mystery of why there's extra columns, it shouldn't be. The columns are representative of the operating expenses minus capital improvements. So you'll see A, B is for years 16, 17. D will be representative of the year 2018 without the capital improvements, and year G will be representative of 2019, again without capital improvements. When we look at the property, we see that it's performing well. Apartment revenues up 2.9% in 2019. Gross potential income is up 2.7%. Vacancy is stable at 3.2% for a 3-year average. If you include concessions, it raises 0.1% to 3.3% for a 3-year average. Effective gross is up 2% in 2019. And again, we did talk a little bit about the increase in expenditures. Looks like 3 years in a row now. 18% increase in 17, 11% in 18, and another 12% in 19. Even with that increase, we noted that there was a 3-year average of 2.1 million, or 22.1% of effective gross. That's again as long as you're using the columns that did not include capital improvements. The net operating income was down 0.8% in 2019. When we look at our projections, columns E1 and E2 made before the 2019 information was provided to the county, we could see, and again, the board's familiar with this, we underprojected almost across the board. We underprojected gross potential income by 156,000, 1.6%. We underprojected effective gross by 402,000, or 4.2%. We did underproject operating expenses by 440,000, or some 19%, and that led to a slight overprojection of net operating income by 37,000, or 0.5%. So 0.5% difference between what we projected for January 1st and what came out in column G once the capital improvements were taken out. So pretty much spot on. We did test the new information, again, as the board is familiar with, and that would show up in columns H1 and H2. Really was a fairly straightforward process, other than we noted there were some slight increases on the revenue side due to the rent roll that was provided by the owner. Mr. Chitlick was curious where the 4% stabilized vacancy and concessions came from. That's a generous uptick, if you will, from the last 3 years. Again, stabilized at 3.2%, 3.3% if you include concessions. The board is familiar with the Virginia code, which allows you all to consider the actuals that's going on at the property. If you were to actualize and stabilize the vacancy concession over 3 years, you again get 3.3%. We rounded up to 4%. Again, increased the operating expenditures essentially right in line with what they spent in 2019 minus the capital improvements at 24.3% of EGI, and still came within, I believe it was 1% of our original assessment January 1st. And so the test value didn't indicate a revision, but rather a confirmation of our original January 1st assessment. We do believe that our number is more representative of what's been going on over the last 3 or 4 years. Again, especially if you consider the inappropriate expenses that we included. And specifically, when you take a look at the appellant's pro forma column I, they would have you believe that the net operating income is lower by almost $700,000 than anything that's occurred over the last 4 years. We believe that the property, again, is operating stably. They only have the one appellant, the one commercial tenant who's in place now. I believe he just signed a new lease. So that being said, again, based on the metrics where we underprojected near across the board, we're within 0.5% of what was achieved in the operating year 2019. We do believe that the county should be confirmed at $139,055,900. Thank you.
Okay, thank you, gentlemen. Questions from board members? Mr. Hoffman.
Yeah, Jeremy, I caught you said you thought 2018 column D expenses was off by about 13,000, but I didn't catch the number for 2019.
So if you look at column C, he took the actual reported expenses were $2,098,000, and then he recreated it with column D and took out what he felt was the CapEx. So he took out $13,000. In column F, the expenses were $2,478,000, and he recreated it in column G, and he took out $133,000.
All right, so you felt the $2,478,000 was accurate.
Correct, and that's what's reported on the I&E, just like the income is. So there's never a question of are all your other incomes truly income items. It's always, you know, I looked at the expenses. I think some of these categories are a bit too high, therefore I took it down.
Okay.
He even testified to that and said, when you look at the rent roll, the incomes could be a little bit higher, yet the expenses can never ever be higher.
Actually, I didn't attest to that.
All right, thanks.
Okay, Mr. Lawson.
What were the quote capital improvements that were disallowed?
Are you asking the county?
Both. I'm sorry, both.
Okay, Mr. Chikas.
Well, we don't know. We don't get that information.
Chris sent an email, and I think he referenced it where he asked like 10 questions, and we responded to every question with exactly breakdown of what each line item was. The term capital is used interchangeably through a lot of different owners and developers. The original thought of capital is something that is done to improve your property. So capital can be, I'm renovating the lobby because once the lobby's renovated, I get an extra $5 per unit. A lot of owners, although, say capital as items that need to be done. So if you need to repoint some bricking out front or things like that, that would be considered capital, or repair a roof, that would be considered capital, yet you're not getting more because your roof was patched. So it's just typical everyday cost associated with it. And it's not a large number. I believe it was like $50,000 for the year for a apartment this size.
What was the action that was disallowed? I mean, was it painting a room, putting a carpet in? What was it?
I don't know what he deemed allowable and not allowable. I don't know why he removed it. I could tell you that the owner reported it as cost associated with maintaining the property year over year, and he determined that that wasn't acceptable. So I can't answer what was allowed and what was disallowed and why.
Yeah, Mr. Larson, if you'll turn to page 144, you'll see the emails that go back and forth. What was listed was $39,432 in miscellaneous building expense, $85.75 in exterior repairs, $59.86 in amenities expense, $5,700 in procurement allocation, $22,300 in building repairs, $38,760 in common area, $93,367 in turnover costs, $132,952 in capital costs, $12,714 in casualty costs, $19,000 in pool services, separate from 1,700 in pool. So these are fairly vague responses. So when we ask for follow-up on certain categories, we respect that to get that information back. But in regards to, common areas, 72,000, miscellaneous, 36,000, I think there's a difference between how the building's reporting capital and annual operating expenditures. There's just so many different ways to spend this money, and they've found all of them. Rather than line item them and tell us exactly what's spent, it's usually just grouped into a larger number. So as was explained before, capital expenditures are not an annual operating expense. Mr. Chitlick just testified that there's a return on investment expectation.
Yeah.
Chris,
I totally disagree.
Chris, wouldn't it be something you would depreciate? Wouldn't that be a capital expense?
Depreciate?
Yeah, that in your accounting of your building, you would depreciate.
We wouldn't, but I assume the owner.
No, I know you wouldn't, but
yeah, that the owner did, and that's why they used to align these below the line. So these were assigned with things like depreciation, amortization. We brought up a 2015 INE that was provided by the ownership earlier this year, and we were admonished for that. So we pointed out at previous attempts that these things were listed below the line, below the net operating income, which is where it's appropriate.
Can I respond to that, Barnes?
Sure.
The playing naive card of this is what I have is a bit frustrating because as most of us we've been dealing with these for 4 years, and the county has asked us to include everything on these forms, report them. First, they did do the internal forms like Chris mentioned, and he didn't point out the rubs were also below the line, which he pulled up, which further supports my claim earlier that they'll take income up and not expenses. But then it was told, put it on the form so we can understand it. We put it on the form. Last year, we came in front of the board reduced this from 139 to 134 and said, look, we need to see more than 1 year of this drop. We now see 2 years of the drop, and the county's basically said, you put it on our form, but we don't like the way you put it on our form. If you look at that email that he just referenced, there's 11 questions, and we answered it with great detail on every one. So him saying that we're ignoring the questions or we didn't get him what he needed is completely false, and the paper trail's right there in front of you. He does this for every case lately of here's 11 more questions, tell us more about the form, which we've been answering on every single one. So it went from, you gave us the internal form, that's below the line, we can't include it, but the other stuff below the line will be included too. It's on our form, but we don't like it how it's on our form, and it's only been on our form for 1 year. So now it's on our form, we don't like the way it's on our form, we need more detail and it's on our form, and the more detail you provided is not enough detail. But the fact is, we're at 25% expenses here, which is just in line with every other property.
But let me go back to this. So for example, fixing the lobby, that was one of the items referenced. What was it?
Fixing the lobby. So common area is not just lobby. Common area is hallways, elevators. It's everything. It's not just a lobby. There was no lobby renovation at this property. This property is actually huge. So there's a large amount of common area. So $38,000 in common area maintenance. I can't tell you exactly today what that is, but I can tell you that's in line with what that cost is year over year over year over year. So that's a normal maintenance cost.
And this is certified as accurate by your client.
Correct. He's a publicly traded company who reports this to the FCC.
Yeah, but this is the same gentleman who also included capital improvements on other cases. So we know that they do that. This isn't a surprise.
We can't possibly get the county what they need with this client. We've tried everything for 4 years now, and then we get to this level and they say, you know what, this still isn't enough. We don't hear that until we get to this.
Answer the questions that are posed. That's the way we find out the answers.
You sent 11 questions. We answered every single one of them. I'm
not at an email from the 7th of August that was not responded
The questions asked and answered. I'm going to put a stop to this.
Yep.
Let's play fairly here. Okay. Any other questions from board members? Mr. Penaranda.
Yeah, I have one for Mr. Chicas. This is basically on the paperwork that we have. On page 2, you say that we need to confirm the value of $224,527,700, and then of course we're dealing with the value of $139,055,900. I need to know this because when I review the minutes and the orders, I need to see what values I'm looking at on the.
Yeah, absolutely. No, the value should be 139,55,900. I don't know. We may have just
And that's on the 12 parcels that we're talking about.
exactly. My guess is they just added up incorrectly, but
Yeah.
Okay.
I sent Chris an email to that yesterday. I think it's just a misprint.
Okay. All right. Thank you.
Okay, Mr. Metzgen.
I'm not sure who this is for, so I'm going to give you the background and I'll lead to who the question's for. In the appellant's original 8 minutes, he mentioned that there were some perhaps disagreements between the appellant and the department about how certain costs, which column or line item they ought to be in, but talking about decoration and painting and whatnot. But nonetheless, whether it was in the wrong section, it was still a capital improvement item or a maintenance item, an operating expense item. So you get to the bottom line, all the numbers are there, and it all adds up to be the proper amount of money that ought to be considered to reduce the EGI. So I guess the question is for the department on those numbers, although I hope this is the right term, the section might be wrong, it's in the right overall operating expenses versus capital improvement expenses. So for Mr. Tikas, do you have any, are you maintaining, and I guess we're going back to the little set to we had just before Mary cut it off, are there any operating expenses that should be capital improvements? I'm getting into a morass here. Do you have disagreements still with the contention from the appellant that the sections were wrong, but the overall topic, capital improvement versus maintenance, is still legitimate and cogent?
Well, I'd say it a different way. In other words, what we're trying to find out are these are appropriate annual operating expenses that are needed for the upkeep of the property the way it sits, or these things that are done to enhance the property, either add long liveness to it or to add profitability to it. So there's a feeling that we are asking too many questions and that it gets into the privacy aspect. I'm not sure what the element is, that we're too inquisitive about what these expenses are. All we're trying to find out are they appropriate annual operating expenses? As Mr. Chitlick testified, there's a instruction booklet that goes along with this form. We're open 5 days a week, 8 hours a day. Everybody's here to answer any question in regards to what should be filled out on these forms. So all we're trying to figure out is make sure that all owners do not include amortization, depreciation, principal, interest, capital improvements, things of that nature. So when we ask these questions, we may in fact ask follow-up questions to find out what these things are. The flip side of that is if these were normal costs, annual operating costs, they should be explained easily. So the idea that they're listed as capital costs, and then if we ask again, it's too onerous for them to break down further. That should be the idea. So when we reconstructed those columns, I think Mr. Chitlick even pointed out that he believes it's a fairly modest amount that we took out. We're not here to manipulate these forms. We're here to clarify. So when the board puts out information, when the county puts out this information, it's to make sure that you understand what we're looking at. And so those columns D and G were added to disclude the capital improvements, which are not an annual operating expense, modest or otherwise. So all we did was adjust those columns to show you. If we're trying to be manipulative, we wouldn't have included the original column. So we're showing you everything that we get from the owner, then we're showing you what we see through our eyes, which are the inclusion of inappropriate expenses.
Let me follow up on that. Maybe you have helped me. I can do it in an example. Common area carpets on every floor. They're 5 years old, and their reserve fund says every 5 years we get in new carpets. Okay, So carpets, of course, are capital expenses because they last more than a year. They're also enhance the look of the property because they're brand new and not 5 years old. I'm just using this as an example.
Sure.
So the department, do you consider the expenditure for all these new carpets maintenance operating expenses or with above the line, or capital improvements that are long-term enhancement, therefore below the line?
So in your exact example, we would consider that maintenance. If this is something that's done every 5 or 7 years and there's a reserve for replacements for that allotment. If we're talking about we're replacing all the units, get new wood floors, there's a new gym, there's a new swimming pool, a concierge table's been created for package receipt, things like that. Those would be considered capital improvements. But if we have something that Mr. Chitlick pointed out earlier, is we believe there's a difference between capital improvements and reserves for replacements. These owners are going to take it into account to have some sort of reserves for replacements to take care of items that are going to be replaced every couple of years. But if we're talking about something whereby we're putting $136,000 of capital improvements to something which can't be explained, that's where it gives us pause.
Mr. Chitlick, you want to respond?
Yeah, I think so. To confirm, what Chris is saying is he would not include that carpet expense as an expense item because he's giving us 20 basis points in the cap rate. Is that correct?
No, I didn't say that.
I know you didn't say that, but isn't that correct? Isn't the replacement reserves, he's saying that's captured in the replacement reserve, which we're getting in the cap rate. So that carpet expense would not be included as an expense item in the income statement.
No, I'm saying that there's also a difference between if we're talking about ripping out every carpet that's in the apartment and either refurbishing it, shampooing it, things like that, as opposed to replacing it every 5 to 7 years. If we're talking about maintaining it, that's an annual operating expense. If we're talking about replacing it every 5 or 7 years, that will be a capital expense.
Okay, any final questions? No, Mr. Chikas, Mr. Lawson.
For the county, for Chris, so you disallowed what you disallowed, not because it was in fact a capital improvement, but because it wasn't answered to your satisfaction. Is that a fair conclusion?
No, it was more the former. That was listed as a capital expenditure. If they felt that was something that should have been included, they can explain exactly what that is and sort of make their case for why it should be included as an annual operating expense. But it was listed as a line item by the ownership, so that was taking it
As capital.
As capital. Capital cost.
Okay.
Okay, any final questions? No, Mr. Chikas, if you take a minute to wrap up, please.
Yes, ma'am. We're getting into the weeds a bit anyways, in the sense that if we've seen this before, if we were to make a correction to the under projection on the operating expenses, we would ask that you make a correction to the under projection on the income side, the revenue side. It's almost exactly on par with itself. 440,000 under projection of operating expenses, of 403,000 under projection of operating income. You can see again in columns H1 and H2, even when we bring the expenses up to the exact amount spent in 2019 minus that capital improvement, it still would call for a confirmation of the original assessment, as it's within 0.5% of January 1st assessment. Again, the balance net operating income projection is some $700,000 lower than it's ever been occurred at the property, regardless of operating expenses. And that's after he calls for a 7% increase on top of the 12% from last year. Given that we underprojected on the revenue side as well as underprojected on the expense side, we do believe that the county should be confirmed at $139,055,900. Thank you.
Okay, thank you. Mr. Chitlick, if you take 1 minute to wrap up, please.
Yes, I'm glad Chris brought up last year. Last year, the value was $139.1 million when we came to the board, and it was reduced to $134,778,000. I know that's not seen on this packet because page 1 and 2 have an error on the value. Now, and that's when the incomes in the last 3 years were 777573. There was a downward trend dramatically of $200,000, and the board told us that they needed to see more of a trend and to see the expenses stay at that rate. Well, now it's gone 7-1. So the last 4 years, the incomes 77757371, but the assessor's ignoring last year's reduction of 134.7 million and reproposing 139 million. So last year we're at 134.7 when we had the income $200,000 higher. Now we see an additional trend. One thing I want to point out about capital cost, which the county will never give us credit for, is if a tenant destroys a unit, you keep their security deposit. That security deposit goes towards other income. Yet to fix that, the county says, no, that's capital, we can't have it. So if they want to dig in as deep as say, what is that capital? You need to also dig in and take out the reciprocal income that comes with it. For the county just to say, I'm only looking at expenses and nothing else is completely wrong. And then they also tell us that everybody gets a 6% vacancy rate, which is used to calculate the cap rate. But here, he basically said, look, our NOI is fine because this is where it is. His NOI, when you add up column H1 and H2, is about 7.3 million. The income is 7.16, trending downward $200,000 every year. If you're looking at this property as a buyer, you're going to see 77, 75, 73, 71. What's next year? It's probably about 6.9. The county said, no, it's going to shoot back up to 7.3. Well, now we know it's not shooting up to 7.3 because of the world we're in. But even as the beginning of the year, there's no way to justify that. So last year we're at 134 million. This year we were at 139, reduced to 134. This year we're back to 139. We're in a much worse spot than last year, $200,000 less, and the county won't even take us back to 134. So that's it.
Okay, thank you, gentlemen. Okay, it's just among the board members now. What's everybody think? Mr. Lawson.
Yeah, I'd like for my colleagues to help me with my memory. Didn't we have a case recently where an amended statement was submitted by the owner clarifying expenses versus capital, or am I misremembering?
I don't recall, but I'm. What's the point?
I guess the point is that if the owner put it in the wrong place, they should have amended or filed a corrected statement.
The issue discussion is they have a difference of opinion. Was it in the wrong place or not?
Yeah.
So they don't feel they should have filed an amendment.
Well, they put it in capital improvements. And the argument is, well, that was an error. We should have put it in maintenance. Because I think that's what this whole case resolves itself over, that one issue. And I'm really not sure what to do. So I'm looking for guidance from my colleagues.
Right. Well, if the consensus is to move it, I mean, the board certainly could move it. Other comments? Mr. Hoffman.
Yeah, I was kind of initially looking at if the expenses should be 24 or 25%, and then as I was going through it looked like the department was doing the same thing and split the difference and made it 24.5. So I don't think it's that far off. So I'm kind of inclined to just go with the department on this one.
On the
test
reduced rate, yeah. Okay.
Yeah, reducing to the test column.
Okay.
Sorry.
Others? Mr. Penaranda?
Yeah, I've been pretty much doing some numbers with both the expenses. I think the vacancy, we tend to not necessarily look at the guidelines if we have a record of it of previous years. So I'm okay with that. By the expenses, yeah, I think the number that is listed on the reconstruction, I think it's much closer than what it should be. In my opinion, maybe it could have been a little bit higher, but I'm okay with it.
Okay, Mr. Metzgen, you had a comment?
Now, I was going to go with we seem to have an unusual amount of disagreement on expenses, whether they're annual or long-term, above or below the line, more than surprisingly we normally do. And I'm in favor of splitting the baby a little bit per Greg Hoffman's suggestion. This is an unusually tough case. I'm not sure why, because it fits within the normal parameters. So, but I'm sympathetic to the appellant's various appeals. And and I know it's not crystal clear, and therefore we ought to go by definition with the department. But if people feel sympathetic as well, I'd like to shave a little off per, again, Greg's suggestion, because that is a solid number. Anybody have any response to that? If not, I'll go with the county, because again, it's not clear and they get the benefit of the doubt.
Yeah, I just want to clarify, because Mr. Hoffman, I thought you said you were working on that, but then looked at the test column and were okay with what they did on the revised.
I think the test column looks good to me.
Okay.
The county is recommending confirming the original number, but I'd
Right.
support reducing it to the test column.
Okay.
Okay, that clarifies it for me.
Okay.
All right. Yeah.
Would somebody like to make a motion?
All right, I'll motion reducing the assessment to 138,393 even, in accordance with the numbers in the county's test column.
Okay, I'll second it. Motion and a second by myself. All in favor? Aye.
Aye.
Opposed? Unanimous. It's reduced to the county's test column, 138,393 even. Thank you, Mr. Chitlick. And the next and final case is RPC 14036 233-801 North Monroe Street, and Mr. Blake Warren is on the call speaking on behalf of the appellant. Mr. Warren, you can start with your 8 minutes.
Thank you. Can you all hear me?
Yeah.
Okay. So this is the Virginia Square Plaza Apartments. Would like to direct the board to page 40 of 102, which is our summary of facts. This property consists of one RPC. It's currently assessed at $76,489,000, or $339,951 a unit. The county has recommended no change, and what we're asking for from the board today is a requested value of $70,569,500, which is $313,000 a unit. This property was originally built in 1999. It's 225 total units. It's a high rise in the Ballston, Virginia Square submarket. It's as you can see on the map at the bottom of page 40, it's in very close proximity to the Virginia Square Metro. And the merits or details of this case, issues of this case, we can find on direct the board to page 3, the apartment income and expense summary page. There were two issues initially when we filed this appeal. One was the overestimation by the county in terms of the gross potential income. The column D, you'll see their total GPI of $6,263,836 was higher than anything that's been reported in the last 4 consecutive years, including column E, which is the most recent 2019 reported year. In their test column, upon seeing the 2019 reported income at $6,188,355, it actually increased to about another $8,000 in the county's test column to a total GPI of $6,272,174. So there's an issue here where both the initial assessments and column F, the test column, the GPI is higher than anything that the property is capable of achieving in the last 4 consecutive years, and continuing forward, they've never achieved levels of income that high at the property. So we're asking the board for relief there. The second issue was with regard to operating expenses. Last 4 years, consecutive years of operating expenses that has been reported to the subject property was in 2016 at 27%, 31.77% in 2017, 30.89% in 2018, and then most recently 32% in 2019. The initial assessment used a operating expense ratio of 30.5%. In their test column, they did revise up and in line with the most recent reported historicals at the property at 32%, which we are in agreement with. So really now what it all comes down to is the overestimation still after seeing the 2019 reported income at the subject property of $6,272,174. That's really the basics of the case at this point is with regard to the test column. They fixed one of the issues, but we still have one more issue with regard to how much this property is capable of generating. That's really all I have. Jeremy, I don't know if you want to add anything on.
The only thing I want to point out is the cap rate of this case. When you take out the 20 basis points for replacement reserves and the tax rate, the assessor is essentially using a 4.1% cap rate for this apartment built in 1999. And I'd ask those who are active market participants if they're seeing anything or have seen anything in the last 5 years stabilized trade at a 4 cap, and because we have not, and we've searched not just Arlington but throughout the region. One of the reasons you can justify using a cap rate so low is if you compress the NOIs, which happens when you use a 6% vacancy rate across the board. So the assessor uses a 6% vacancy rate. It produces an NOI a bit lower. A lower NOI versus sale produces a cap rate a bit lower, which is fine. But then starting this year, which I have not seen in my last few years in Arlington, the test column has abandoned that 6% vacancy rate. So we've gotten the understanding that everybody gets a 6% vacancy rate. Well, look at column F. We lost our 6% vacancy rate. This is a test, not a reconstruction. I know it has different names, but this is a test. And the test should give 6% vacancy rate because equalization, the Board of Equalization, every apartment built in 1999 for reassessment got a 6% vacancy rate. That's of this age and this size. Is a high rise like this. So if we come in front of the board and say, here's our new income, they said, that's fine, but you're no longer get the 6% vacancy rate. We are now out of equalization. So if anything, column F should have the same vacancy rate that all other properties like this. And if not, we then become out of equalization. So I know equalization's burned us a lot of times in the past when we come here on specific cases, but in this one, it absolutely helps us. Because again, if every property at reassessment every high rise built in 1999 at reassessment received a 6% vacancy rate, and per our understanding, and this is a company that represents about 40 apartments in Arlington, everyone we've seen has used the guideline vacancy rate. But we get here, the test abandons it, and we think that's an issue, and that takes us firmly out of equalization. That's all I have.
Okay, thank you. Mr. Chikas?
Yes, ma'am. Just to start with that last note, Mr. Chetlik has a problem with how the Virginia Code is written. He should obviously take that up with Richmond or his representative in the State House. What we're doing with the test column is exactly that, is just highlighting that the board has the ability to consider the actual expenditures, determining fair market value, and that's through the income generated from real property and loss income attributable to vacancies, collection losses, and rent concessions. So if we're starting with the summary sheet, again, the board's very familiar with how we look at these things. Page 3 shows a 4-year income and expense summary sheet. What we can see is that, again, the property is doing well. Apartment revenue is up 2 years in a row. 2019 is up 0.5%. Parking revenue is up 2 years in a row. 2019's increase at 8.3%. Gross potential income is up 2 years in a row, year over year. 2019's increase is 1.4%. Building's very stable. True vacancy stabilized to a 3-year average of 1.5%. It's virtually nothing. Even when you include concessions, we see a 3-year stabilized vacancy concession of 3.4%. Effective gross is up 2 years in a row, year over year. 2019's increase just shy of 4%. We did see that operating expenditures ticked up approximately 7.6%. That was after a year of decline in 2018. They somewhat smoothed out for a 3-year average of 1.86 or 31.6% of effective gross. We saw net operating income increase 2 years in a row. 2019's increase at 2.2%. Mr. Warren had pointed out a lot of these things that brought him consternation was the idea that they've achieved revenues never seen before. But that's been the case a couple of years now. In 2016, gross potential income was higher than it had ever been. 2018, it was as higher than it had ever been. 2019, it's as high than it's ever been. So with a successful property, you're going to see year over year breakthroughs as far as the revenues achieved year over year. Especially one that's operating with a vacancy concession as light as it is at this property. Again, as Mr. Warren noted, it's about a half a block from the metro. It's in a lively area, neighborhood, and it's performing well. When you look at the county projections made prior to receiving the 2019 income and expense form, you'll see that we actually over-projected our gross potential income at almost 75,500. But even still, considering that we used a stabilized 6% guideline vacancy and concession, and the property was running at approximately 1.95, we underestimated the achievable effective gross by 180,000, almost 3%. We did underproject operating expenses by 145,000, or some 7.5%. But again, even if you were to raise those to the exact amount of the penny spent, you'd still be almost $35,000 shy of the achievable net operating income. And again, the $4,092,000 that we projected is well in line with what's gone on with the property over the last 2 or 3 years, especially considering that we underprojected when you look at what was achieved at the property in 2019. Again, a 2.2% increase. We did run a test, and as you can see in column F, the board is very familiar with it by now. We used the exact rent roll that was submitted by the owner. That's how we were able to get a projection, fairly tight projection on the gross potential income. We used the 3-year average that's going on at the property, which again is more than generous considering it's almost twice as much as what was incurred at the property last year. We used the 32% operating expense. It still came out to a NOI that was actually lower than what was achieved last year, but a value that's higher than what the county projected for January 1st. Again, as the board knows, we don't call for a increase of an assessment without a third party appraisal. So that being said, we do fall back to column D. Again, under projection on effective gross income, under projection on net operating income, and even if we were to make adjustments to the operating expense, we'd ask you to obviously make adjustment to the revenue side. That being said, we believe that the county should be confirmed at $76,489,000. Thank you.
Okay, thank you both, or all three of you actually. Questions from board members? Mr. Lawson?
Yeah, this is for the county. Where did the 6% come from as far as the vacancy that the county uses 6%? Where did that come from? From the study?
Yeah, exactly. It comes from the income and expense forms that are turned in by the county owners.
So you look kind of county-wide at what that ends up being.
Exactly. We look by property type, and then we'll break those up into categories.
On the test, this particular owner is very efficient, and so they probably move tenants in quicker because they have so many projects, and they probably turn them over, clean them up, paint them faster than most people. Do you think it would be fair, given the fact that if it were a different owner, they probably would not achieve this efficiency? Do you think it would be fair in the test to up the vacancy?
The test is reflective of what's going on historically at the property. So in other words, if it's in their benefit, they get that number too. We're just showing you, per the Virginia code, that the board's allowed to consider the actuals that's going on at the property. So again, rather than use the 1.95 that had occurred actually at the property last year, we did an average of 3 years, which came out to 3.41.
So your argument is that it's offset by more income.
Well, it is. Yeah, that's the idea.
But Barnes, that's, if you look, they took the average of the total vacancy, but the total collections have been, concessions have been 170, 188, 130, and 34, and they gave us 0 for that. So they didn't add vacancy and collections together. They just took the vacancy.
No,
I'm sorry,
we didn't.
vacancy and concessions.
Yeah, that's
So the
exactly.
vacancy and concessions
Okay,
were,
Mr. Chitlick, I'm going to cut you off there. You can say that in your wrap up if you want. Is there any other questions for either party? No? Okay. Oh, I'm sorry, Mr. Hoffman.
Yeah, what are you calling concessions? Is that like a month free rent?
correct. Concessions are free rent calculations.
Okay.
Okay, no final questions. Mr. Chikas, if you take a minute to wrap up, please.
Yes, ma'am. So again, just to reiterate, we are in fact including true vacancy as well as concessions that are listed. 3.95% in 17, 4.32% in 18, and 1.95% in 19 equals an average of 3.41%. Again, that's almost twice as high as what's been achieved at the actual property in 2019. Again, we projected our income based off of the information supplied by the owner and the rent roll. And that test value came out higher than our January 1st value. Again, looking at our January 1st value, we underprojected by over almost $180,000 of achievable income due to the extreme vacancy and concession occupancy at the property. So if we were to make a change to the operating expense and get that more in line with what was occurring at the property in 2019, we ask you to keep in mind that, again, any projections made by the county were ahead of time of receiving the 2019 INE. So adjustments made to the operating expenses, we'd ask you to make the same adjustments to the income side, thus confirming $76,489,000. Thank you.
Okay, thank you. Mr. Warren, if you take a minute to wrap up, please.
Yes, again, if you look at the total GPI that was reported, the 4-year average over the last 4 consecutive years would be 6,090,818, which is a little under 200,000 below the GPI estimate for the county's test column. That the actual GPI reported in 2019, the most recent year, is approximately 83,000 below the county's test column. So again, they made appropriate adjustments, we believe, for the operating expenses, but they're still overestimating anything the property has been capable of generating over the course of the last 4 years, as evidence here.
Yeah, we came to the county and said, look, you overshot GPI by $80,000 and you undershot expenses by $150,000. Can we have an adjustment? And what they basically said is, yeah, but you got a 6% vacancy. Now you get a 3% vacancy. Value should be higher. By giving us a 3% vacancy, we become out of equalization, because every apartment like this in the county is getting it. And we say this isn't correct, and the response is call Richmond. So if you look at it, this property is overassessed and out of equalization.
Okay, thank you. I'll start because I feel like today we've had a lot of nitpicky, very childish comments going back and forth between the appellants and the county. But that being said, I mean, the appellant's argument now that, that because they're not getting 6%, they're out of equalization, that's not true. I mean, they were given 6% in the initial assessment. And the idea for the guidelines is not to end up with a number that's lower than what the property actually produces. So when they did the test, it does do something more realistic and puts it down to the 3.41. And I'm fine with that. I mean, when you look at the bottom line, if you take the test column and apply the 6% standard vacancy, it ends up at 3.9 million, which is lower than what it has done in 1, 2, 3, 4 years. It's pretty close to, lower than 3 years and pretty close to 1 of the years. So, the idea of the guidelines aren't there to end up with a lower value just because the guidelines say it should be this. I struggle with this. We hear it from other appellants, but the bottom line is the numbers are the numbers. I'm fine with the original assessment. You want the 6%? It's in the original assessment. If you're going to get hung up on that one point, the county, I think it's a little high on the test, but I'm fine with the original assessment. So I'd love to hear what other people think. Mr. Metzgen.
I'd like to extend that a little bit, because that, both in this case and the prior case, it was a vacancy issue. And we often do see the guidelines applied even for vacancy, even when it's a higher percentage than recent experience. But it wasn't contentious in the last case as it was here. And I've determined that there's an established 4-year percentage-wise absolutely way below the guidelines. And therefore, in this case, although oftentimes guidelines are applied, in this case, it doesn't make sense because it's established 4 years in a row, way under the guideline. So when I originally had problems with it, I no longer do, and a lot of the same reasons that Mary just mentioned. I also wanted to mention the rent rolls. Going up 1.5% from year to year is not at all unusual, particularly in a primary premier location like this. So to keep it flat, as the appellant has suggested, doesn't make much sense to me. So from the income and the diminution of income, vacancy and concessions, it turns out to me at least that it all makes sense, and I'm in favor of keeping what the department has proposed.
Okay, others? Mr. Penaranda?
I agree with both statements that were made. I think when you get the benefit of the numbers in either column before the EGI or after the EGI, I think the NOI is really what we're looking at to see what the final value is. So I'm fine with it. I'm okay with it.
Yeah, that was a good extension of the thought. Thank you.
Right.
Mr. Yates?
I was looking, I agree with both those comments, but I was looking at the apartment revenue and how it did jump in the assessment a little bit more than normal. But I can see how the county came up with it. And there's a steady movement there. And it was a reasonable number. I mean, could it be a little bit high? Yes. But I don't see any reason to change the entire structure of the deal or the assessment. I would go with the assessment.
All right, anybody contrary to that? No? Then I will move to confirm the county at 76,489,000.
I'll second.
Okay, motion is second by Ms. Hogan. All in favor? Aye.
Aye.
Opposed? Okay, it's unanimous. The county's confirmed at 76,489,000. Thank you,
Thank
gentlemen.
you, board members. Thank you, Ms. Warren. Thank you, Mr.
Thank you.
Chadwick.
Thanks.
Okay, that completes the calendar for today. One of the things of business for board members, tomorrow there's two, Mr. Yates and Ms. Hogan are not able to attend, so I just need to make sure that everybody else is going to be here tomorrow so that we have a quorum.
Yes, I'll be here.
Okay,
Yeah, I'll be here.
okay. And okay, so we're good. So we'll have 5 people for tomorrow.
Just wanted to clarify, what happened with the third case that we had today? Was that
The
withdrawn?
third case was withdrawn prior to and didn't need our approval,
Okay.
which is, why it got removed from the agenda totally. Okay,
Okay.
so does any other member have anything else that we need to talk about? We got the quorum for tomorrow. Anything from the county? No? Okay, then I believe this is our earliest that we adjourn at 9:58 and we'll re-adjourn tomorrow, the 16th at 9 a.m.
Okay.
Thanks, everybody. Bye-bye.
Thank you.